Good morning, everyone, and welcome to Morning Markets here at True Potential. Now, you'll see on your screens that the optimism, which has begun early in the new year, has accelerated over the last few days in markets. Please tune in to last week's podcast where Chris Leland, the head of investment strategy here at True Potential, gave more details on what's driving the returns in your investment portfolios. He really did break it down in great detail for all of our clients here at True Potential. Now, what we are seeing is that whilst economic data across the UK, Europe and the US continues to point to a rather marked slowdown in economic activity, markets are focused on some more positive outcomes early in the new year. Now, unemployment levels remain remarkably low for at this point in the economic cycle. And we do know that as we've reported it to you considerably over the last 6 months or so, that the jobs market remains tight because employers are finding it difficult to recruit new staff. Now, this unusual phenomenon has led to the materialisation of something which we would describe as labour hoarding. That is, rather than shedding some workers at this point in the economic cycle, corporates are very keen to hold on to workers and are perhaps finding other ways to try and lower their costs, such as reducing the overall level of aggregate hours worked, perhaps in industries where more people are employed part-time, or perhaps looking at other parts of the businesses where savings can be made. And this is all in an effort to try and avoid the difficulties that occurred last year when companies were busy rebuilding their labour force inventory. And corporates looking ahead to any short-term slowdown don't want to go through this again and lose workers unnecessarily to rivals in the industry. So all this has challenged this early market narrative of a sort of stagflationary slowdown. That is, there would be high levels of inflation and low levels of economic growth. And of course, market optimism in much lower inflation prints over this year globally has increased because base effects will see these inflation numbers roll over, but we're also seeing subdued readings in oil prices compared to where we were last year, and also wholesale gas prices, which is particularly acute for the UK and Europe. So any continued moderation in gas prices should, for instance, help lower the price pressures here in the UK when the energy price cap freeze continues to be refreshed at the end of each quarter for the year ahead. But the reason for optimism in the new year isn't hard to find. One of these is in China. So it's now the Chinese New Year, and for the first time since 2019, citizens there are free to travel domestically and internationally to some extent to spend time with their family in this key moment in their year. But of course, the reopening of the Chinese economy has wider implications for economic activity there. And we're beginning to see that in the price rebounds we've seen in some of the industrial metals on the commodities market, in particular in iron ore and copper, which are up 11% in the last month. And this is reflecting the expectations of a more normal rebound in infrastructure investment. Infrastructure investment is such a key part of Chinese economic growth, so there's expected to be a rebuilding boom in China in the year ahead. We're also expected to see Chinese consumers who will be more free to spend to start to draw down some of the so-called excess savings. And this was a phenomenon we saw in the US, particularly through 2021. We're expecting to see some of the same type of behaviours this year in China. And these are strong proponents for growth, and the particular beneficiaries of those should be Europe and the emerging markets, who are direct exporters into the Chinese economy. Now, we're almost at the end of the month. So what we've seen so far from corporate earnings updates in the US is a bifurcation in some of the updates. So whereas, for instance, the US banks have reported a moderation or a slowdown in earnings, and in some cases have disappointed, they have begun to react by shedding some of their workforce. So the banks looking ahead are becoming more cautious and trying to reduce their costs. However, if we look at a company such as United Airlines, they gave a remarkable update last week on this quarter ahead. So they've seen a 50% increase in revenue for this quarter versus the same quarter of last year. They're also seeing a double-digit growth in revenues for this quarter versus the same time in 2019. So even looking across the COVID disruptions, they've seen and associated increase in prices, they've seen a remarkable double-digit growth in revenues. And this continues to indicate that whilst Wall Street faces pressures, perhaps from just corporate activity slowing down, becoming more cautious, Main Street, or the US consumer, still insists on spending down excess savings and enjoying these post-COVID freedoms, and cyclical activities such as travel and recreation are the beneficiaries of that. And it should be a bumper summer for the US domestic economy as the US consumer spends the last of those excess savings. Now, we're about a week from the next set of central bank meetings from the US and the UK. So there will be a rather quiet week in updates from central banks, but we will get the first of the new refreshed economic activity updates for this month, and they begin this afternoon. So please do join us tomorrow, where colleagues will update you on the latest reads from economic activity. And of course, please tune in to last week's podcast, where you can get an update on how your portfolios have done for the month so far. Please take care. Thank you.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.